This podcast is intended for investment professionals only. Hello, and welcome to the second of Market Talk for September. In this episode, we'll be analysing what's behind Apple's recent share price fall. We'll be looking at the state of the Eurozone economy, given recent weakening economic data, and we'll be asking what's on the agenda in the US and UK as policymakers gear up for next week's all-important central bank meetings. So, against the exciting backdrop of the Rugby World Cup, kicking off the questions is me, Frances Watson, here in the UK, and providing us with the winning answers, Ben Bennett, who joins us from Hong Kong. Ben, hello to you. You a fan of rugby?
Yeah, love it. I think the only problem is the time zone. I watched the England-Argentina game, but it started at 3 a.m, so I had to watch it the next morning and not look at my phone for hours. So just in case I got any messages. So no one text me, please, particularly if England wins. That's probably not going to be a massive risk.
Well, you've got to keep your priorities in focus, haven't you? I suppose we better talk work as well, Ben. So look, let's just focus on some economic data because there's a bit of a pattern emerging, isn't there, between data coming out of the Eurozone, weak data, but the US holding up for now. So just talk us through what that means.
Absolutely. It's sort of the weak bits of the economy are winning over the strong bits. Now, hands up, holding my hands up, I thought we'd be in a worse position this point in the year in the US. The US is definitely doing stronger, but just about everywhere else is in line with those expectations of potential recession, or even in the case of China, doing worse. So for Europe, as you say, we knew that the production cycle was weak in Europe. So manufacturing had been weak for quite a long time. Service sector had been holding up because everyone had been going on holidays post-COVID, but it's actually the service sector, at least in terms of sentiment, these PMI sentiment indicators, it's the service sector that's coming down to meet the manufacturing, as opposed to manufacturing doing better and reaching up to a strong service sector. So yeah, bits of the European economy look as though they are in recession, contraction, or at best they're stagnating. Germany, for example, could well be another country that does 2 negative GDP prints in a row. Like I said, not a massive recession yet, but they are stagnating. We're going to see, we're still seeing tight monetary policy. It doesn't look as though there's any relief on the near-term time horizon.
And of course, we've got the ECB meeting this week as well. So difficult situation for Madame Lagarde there then, with sticky inflation and slowing growth.
Very tricky. In a normal situation, you'd be wanting at this stage of the growth cycle to be cutting rates to try and support countries like Germany. But because of the inflation, as you say, still the latest data that we got was higher than expected. It's still sticky. So and we spoke last time that we chatted about high oil price that's feeding into headline inflation. So that means that there's quite a good chance of a rate hike again, even like I said, with stagnation going on. So this meeting is going to take place on Thursday. So it might have happened by the time people listen to it. I think in the markets, it's roughly a 50-50 call between a rate hike and a no rate hike. Even if they don't do anything, there's a decent chance that they would hike again next meeting. So yeah, they're keeping the pressure on. They're keeping hiking interest rates. That's not good news for the economy that's already struggling.
No, we don't want to hear that word stagflation, do we? And we don't usually comment on individual stocks either, but we're seeing some weakness in the Apple share price. Ben, what's behind that?
I think it's interesting, as you say, not necessarily around individual stocks. It's more around the geopolitical environment that has been bubbling up for the last couple of years between China and the US. So China has been reports anyway from Bloomberg, Reuters, etc., that China is looking to ban foreign phones in sort of government agency, even state-owned enterprises. So if you're a worker for an agency, a state-owned enterprise, you're not meant to be using a foreign phone. And I think everyone picked up on foreign phone and thought, well, Apple is potentially a company that would be massively affected by that, given the sales that they have. And even today, so we're taping this on Wednesday, There's even more talk. There was a denial by China that they were looking to fully ban the iPhone in China, but that wasn't up for debate not that long ago. And the denial, I guess it's a bit like getting a denial that you're going to sack the football manager. That means that they're in trouble, doesn't it? If you've got to deny it, and ultimately that's another piece of evidence about this dislocation between the two countries, the technology war that's going on between the two countries, and some of the casualties could be big companies that have previously benefited from the globalization trend that seems to be going in reverse.
So watch this space, really, isn't it? Let's just stay with China, because this week we heard that Country Garden, the property developer, has escaped default for now. What ramifications does that have then across for the property sector as a whole, then, Ben?
I don't think it's massive immediate implications, because Evergrande was the big developer that has already gone bust. Country Garden is around about the same size in terms of number of properties it develops, the amount of debt, both offshore dollar and onshore, roughly the same. So I'm giving it the same order. It's not like 10 times bigger or 10 times smaller. It's roughly the same order. So we've already had one default. If Country Garden defaults, the bonds are already trading like they default anyway. So it's sort of in the price. I don't think it would be a massive problem if they did default. I think it would be a huge positive surprise if they managed to use this window of opportunity, so that they've negotiated with bondholders to extend some maturities. They paid some dollar bond coupons, surprisingly. If there was a sudden turn of the policymakers suddenly decided that they want to support and pump money into these developers, equity, fresh equity, get the property market going, then that would be a massive positive surprise. But I don't think, obviously the definition of a surprise means that I don't think it's going to happen. But I really don't think, given what we've been seeing, that that's the reason why they've given themselves time. I suspect they're giving themselves time to try and work out a more sort of steady, sensible way to restructure, as opposed to doing it all at once. So that would be my assessment. So it doesn't really have major ramifications. It probably is, if the bonds are anything to go by the bond pricing, it's probably going to go bust. And we're waiting to see all these defaults, where they feed into the broader Chinese financial system, if there are any serious strains put onto trust funds, banks. That would be more worrying for me. So another developer going bust, not a major issue, but yeah, we'll see if it has a broader, more impact across the broader financial sector.
Yeah, that's the key, isn't it? Look, from China to currency then, last week we talked about the dollar and the strength of the dollar. This week, should we just focus on the yen? Because Governor Ueda has been speaking, Governance Bank of Japan, saying that the era of negative interest rates could be coming to a close. Do you
Yeah.
think that's sooner rather than later?
Yeah, so just taking a quick step back, the dollar, which we mentioned last time, strength of the dollar because the US is doing better as an economy, as we discussed right at the beginning. So higher yields in the US sucking money into the dollar. That's putting pressure across global currencies. So in China, the currency is under pressure, but lots of emerging market currencies under pressure. That's not great for global growth again, because it means that central banks have got to be, they've got to get maybe tighter policy than they would otherwise, got to keep interest rates higher than they would otherwise, because they don't want to let their currency depreciate too much. Now, the yen is a currency that's been under a lot of pressure for a few years now, because they've been keeping interest rates rock bottom, negative interest rates, in fact, at the short end, and they've been keeping a cap on 10-year yields. Now, that's all fine as long as you've got very low inflation. But of course, everywhere is seeing inflation creep up, even Japan, which has been, basically deflation for 20 odd years, 30 years coming on to. So, even they're seeing inflation. And at some point, they've got to stop the rot. They've got to stop their currency depreciating, because otherwise they just keep, they would get that inflation spiral going up and up and up. So it's a delicate balancing act. Ueda doesn't want to declare victory too soon. He's seen before false dawns of inflation going up, and then they've gone back into deflation. But it does look as though he's starting to see inflation bubble up. If he does that, then it will tighten policy. They could remove negative interest rates before long. Interest rates going up in Japan, it's been an anchor. Like Japanese bond yields have been so low that they've kept other bond yields lower than they would otherwise be, because Japanese investors want to go find yields. They've been buying maybe US yields, European yields, but if they can get it at home, then they wouldn't be buying the European and US yields. So they've been keeping an anchor on yields globally, and maybe if that anchor being lifted would lead to globally higher yields. So again, I just think it's another potential driver of higher global yields, another reason why there could be tighter conditions globally. Broadly, it's another reason to be a little bit concerned about the global economy going forward, I think.
Yeah, you've said two quite negative things there,
Yeah.
potential implications. Right, so let's look ahead then to next week. And we've got big meetings from the US Federal Reserve on the 19th to 20th of September, and another central bank meeting from the Bank of England, both facing the same dilemma, to hike or not to hike, isn't it?
Yeah, I mean, we're getting to the peak of interest rates. Some are still hiking. Like I said, the ECB is on a knife edge. The Bank of England is more likely than not, if you look at short-term interest rate markets as we speak, to hike, but they could also not hike potentially. Fed is probably not going to hike, but I mean, they could surprise and hike. The Fed has actually got one piece of crucial information coming later today as we tape. So I don't know what that is, but people, when they listen to this, will know. So US inflation, if that's very strong, maybe that would spur a hawkish meeting by the Fed. If it's not that strong, then they could probably be more dovish. So we're getting to the top of the hiking cycle, but we're not yet getting to cuts. And we've been talking, I think some central bankers have been speaking about getting interest rates up and then keeping them steady for a while and just seeing what happens. Interest rates have a lag. We think that lagged impact is starting to bear fruit in terms of slowing economies. We can see European economies getting into stagnation, even in recession. UK looks as though it's stagnating, if not in recession. And we also think the US will suffer by the end of the year for all the reasons I've been speaking about today, because of that tightening conditions. And ultimately, that's one of the reasons why we're still cautious about equities and credit going forward.
Yeah, it really feels as though the medicine is starting to work, doesn't it?
Yeah.
Okay, all right. Well, let's go from medicines to numbers. And what's your number for the remainder of September, Ben? And why have you chosen it?
It's 6.2. I mean, it's 6.2 inches. This is the amount of rain that fell in Hong Kong last Thursday night. Actually, when I was trying to get a taxi from a restaurant, so that wasn't very nice. In an hour, so 6.2 inches in an hour, which
That's horrific. I can't even imagine. Actually, where did that come up to on you? Actually, you're very tall, so probably not very far.
I survived just about that, and I live on the 22nd floor, so I think we're okay. But joking apart, it was actually very serious here in Hong Kong. It caused flash floods, serious issues, and it's the most amount of rain in an hour that has ever been recorded. Records go back 150 years or so. So it's it's the most that we've ever recorded, and that comes on the back of a typhoon 10 warning the previous week. It feels as though we've had a couple of weeks of pretty bad weather here in Hong Kong, and it feels as though globally there's an awful lot of bad stuff happening with the weather, isn't it? So 6.2 inches is my number of the week, and hoping that that's the worst storms of the typhoon season over and done with for Hong Kong.
Well, let's hope so. And I know that the poor people of Libya, I think, have been suffering too with those terrible floods. It's very sobering and makes us all realise that we need to focus more and more on it. But on that sobering note, Ben, thank you very much for your insights as always. And we will join you again in October. But for now, thank you, Ben, and thank you all for listening. Thank you. As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of legal and general investment management. Forward-looking statements are by their nature subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal and General Investment Management Asia Limited, the Licensed Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.